which is on the topic India's Decade, What is in the Mind of the Market. Please join me in welcoming our next speaker, Krishnan, a Managing Director and Chief Investment Officer from Spark Asia Impact Managers Private Limited. A big round of applause for him, please.
Morning, everybody, and thank you, Transformance, for giving us the opportunity to be present here. Thank you all for being present today. The topic I'm presenting to you today is titled India's Decade and What is in the Mind of the Market. It's a very intense topic, much in discussion, so I will not focus much on the economic theme and the pros and cons of this topic, but we'll try to connect the topic to how the market may look at it as we go forward in this. At the outset, let me just bring to you the chart on India's progress vis-a-vis China. This is an interesting chart. The base year for India is 1991, and that for China is 1982, the respective years in which both countries started their economic reform journey. Both countries were of roughly the same size when this journey started, and by 2007, when China had finished roughly 25 years, and India had finished 16 years, 17 years into its reforms, both economies were similar looking, and the expectation was that India will follow China's path in the next 10 years. And this is something which you have, as a fund manager, I have sold in Europe, and there was a lot of expectation. And look at what happened in the next 15 years. Obviously, India has lagged, and the reasons for that, global economy was not of great support to anybody in the last 15 years as it was to China from 2000 onwards. And then there are other structural reasons as well. But I will just conclude this discussion by saying that we are still in the hunt. We are at a point where it is quite possible that the curve lifts up for India, and it will yet be India's decade going forward. That said, what if it is India's decade? What is it that the markets are worried about, both globally and from India? So far, even though India has not done as well as China on the economy front, we've seen the markets diverging. In the last 25 years, Indian market has given about 7-8% compounded annual return, whereas China has given just less than 1%. And there are strong reasons for that. One being that India has been an income and friendly market, stock market and an economy. Market leaders have been able to consolidate their presence. We have considerable impediments to doing business and for competition coming up, but we have been a friction-free stock market for large part. This has flowed through to higher returns in the last 2 to 3 decades. So I'll focus on a few trends that will be in the mind of the markets as we go into this journey in this decade. First is inflation. The previous speaker alluded to this, and the cost of capital and interest rates. They are all connected issues. The picture I'm presenting to you is that something has changed fundamentally, and this is a decadal shift. And you can see that inflation has broken out from a range it was for as long as 4 decades. And in the 1970s, inflation was high, and that was sort of tamed, and I'm referring to the mother market, the US, that was tamed in the early 1980s by Paul Volcker, the then chairman of the Fed, and that actually set off, and consistently low and stable inflation over long periods of time have led to prosperity, economic growth, income growth, and great stock market performance everywhere in the world. You can see as the US CPI has averaged just about 3%, the per capita income growth has averaged more than 4%. This over a 40-year period is very, very significant. Similarly, in China, the low levels of inflation over persistently long periods of time has underpinned China's success as an economy. And this is something which we may not have had, or we may not have seen in large measure at any point in India. You look at the market performance, the period between 1981 and 2007 was probably one of the best periods for equity markets in the last several decades. That snapped in 2008, and then markets have had a very strong comeback. But the comeback that the markets have had post the fall after the global financial crisis have been helped along by very low levels of interest rates, cost of capital going down, maybe for not all the right reasons. Now something has changed, cost of capital has started to go up, and this will have continuing impact on both the economy's growth and inflation, and equity markets over the next several years, and that's what should interest us. The second trend is financial repression. This is again related to persistently high levels of inflation. Government debts around the world have gone up significantly after COVID. You can see what has happened to the US government debt. And history has taught us that it is in the interest of governments to, if inflation remains high and nominal GDP, which is linked to inflation, goes up as a result of that, it is in the interest of governments to keep inflation rather high from this perspective in order that they inflate away the debt. This is something which governments have I think, done throughout history. For instance, India, this has been institutionalized. SLR is nothing but a legally sanctioned measure of financial repression. This has crowded out savings in which government intervenes compulsorily and takes away the savings. This is inflationary, and inflation in fact aids this. The Indian government debt has also moved up post-COVID significantly, and so has the debt levels in China. Many experts believe that in this environment, inflation will remain a little bit on the higher side for longer. And we are referring to multi-year trends over here. So the current year's debate that inflation may have peaked in the US, interest rates may have peaked in the US or are about to peak, have to be seen in context. They may or may not have peaked, but whether they can go back into the big band that was prevailing in the last 40 years, that's highly debatable. It's unlikely they'll drift back to that zone, and that means we have higher cost of capital, and higher cost of capital has an inverse relationship with valuations, which we'll get into. And markets are in the process of discovering it. And we are not yet there in terms of fully recognizing this impact, because there is a hangover from, what was almost like a free lunch in the last 15 years by way of low cost of capital and cheap money. The third trend is deglobalization. This has been, you can see the chart on the left-hand side. After China joined WTO in 2001, the trade boomed. And China was a source of deflation, and therefore also kept inflationary forces in check over much of the last 2 decades. The world globalized very rapidly. It's very evident from the chart over there. And maybe from the time of Mr. Donald Trump, this has been on the decline, and after COVID, it's further going down. But geopolitics has made this heady mix very complicated. You see on the right-hand side the concentration of foundry capacity in Taiwan. And you know that China has been making all sorts of threats on Taiwan, and the implication of any action from China on Taiwan, which, by the way, we believe is highly unlikely. But the fear of any action from China on Taiwan is huge. And practically, all the small things that we use, gadgets that we use, will probably be unavailable if something were to happen to the foundries in Taiwan. And this fear is going to further drive every country, every large country manufacturer, to look at alternate supply chains over, and this can't be done overnight. So of the three trends that I mentioned, this is ironically very positive for India. Previous speaker referred to the to manufacturing picking up and China plus one. This is related to that. This is a huge thematic tailwind for India for the next many years. We are a large market, and we also have the potential to be a large producer in a variety of things. And as deglobalization picks up, India should benefit. Because deglobalization doesn't mean, I think, globalization going away fully. It means the supply chain sort of, I think, widening out. So those are the three trends which I think are occupying the minds of the market, both globally and in India as we speak. These are longer-term trends and not trends that determine share prices or stock market levels over the next month or quarter. But the overwhelming trend or the factor that occupies the mind of the market, particularly in India, is valuation. And this needs some explanation, whereas I think there is constant reference that valuations have become more reasonable. I'll in one subsequent chart argue why that's not presenting the whole picture. But even on a headline basis, the Nifty earnings went ballistic after COVID, and it just come back into the level of one standard deviation. In the meantime, the India weight in MSCI index, which is a very widely followed global index, has skyrocketed. This is a good development. So on the one hand, you have a lot of money chasing equities. On the other side, we are not at comfortable levels on valuation, and many strategists, observers, analysts are still to come to terms with this. Most of the research and commentary on the subject focuses on incremental data points saying, market has corrected by a certain bit, or stocks have corrected by a certain bit, but the big picture is still very much, I think, very much cautious on valuation. Here is the global picture. This is a very long run data, 50-year data on the US and trailing PE multiples, so there is no bias of forecast in this multiple. And we saw that if you divide the last 50 years into two, the average itself has been lifted up because the last 25 years have been seen valuations creep up. And this has to be linked to the conquest of inflation, as it were, and the drop in cost of capital and interest rates starting the 1980s. Now, with that turning north, it's highly debatable whether this curve can really look up. So it's highly debatable and highly questionable whether in the near term, as in next 3 to 5 years, we can get a bull market in equities anywhere in the world, in the US or in India, which will be fueled by valuation re-rating. A lot of what returns we get in equities have to come by genuine earnings growth. And on the right-hand side is a sort of chronicle of various measures in valuations, whereas the top three measures have remained kind of evergreen for 100 years. Many other measures have come, and at various points have been touted to be the holy grail or something that we are supposed to follow. But most of those measures haven't really lasted for very long periods of time because in some part or the other, there were measures that were brought in to justify prices and not really as consistent measures which we can hold out across cycles. So this is why I believe even as valuations in India at the Nifty level have moderated, as the previous chart showed, that doesn't tell the whole story. The two parts to this, the more expensive part of the Nifty is the curve above, and that has not moderated, or that has not moderated enough because it went up quite a bit, and it has been going up ever since the era of easy money came to be. And whereas it has fallen from the peak, it still hasn't gone anywhere near the pre-existing levels. Whereas the bottom half of the Nifty, that's been, I think, that's been much more subdued in both its re-rating of valuation and the way it has behaved in the last few years. If you really look at the earnings growth in the last 5 years, that spans COVID, of course, these two classes of stocks, and these are simple numbers taken from published data, the earnings growth is not much different. So yet you have several of these stocks in the top half trading at 60 times, 70 times, 80 times trailing PE. And most of the research on the subject, if you look at analysts and look at their research, they focus on incremental data points such as earnings beats, which are somewhat inconsequential now that you have a trending market that has snapped. When there was a trending market from 2008, 2009, all the way to COVID and beyond, incremental data point mattered. Somebody expected 2% QOQ revenue growth and company delivered 2.5%, that was good enough. Now, take the results of TCS. We don't own the stock as a disclaimer. Nevertheless, the December quarter earnings were supposed to be a beat from the point of view of many analysts. It's 0.5% sequential growth beat. Good company, we are not on that debate. But it's meaningless. You look at the whole year growth, it's coming off from the previous years, and it's at maybe at best at, I think, high single digits or low double digit kind of number. And the valuations have re-rated substantially after COVID. And so this kind of analysis which goes back and forth is not going to be very helpful. And as investors, we may be hugely distracted if we follow that. It may be useful to refer to those notes, but the key argument on stock recommendations may not hold forth. With that, I refer to the Norwegian Pension Fund as the world's largest family office. There's good reason why I refer to them as the world's largest family office. In 1969, Norway found oil in the North Sea, and there's a long history to this. There are other European countries who struck gold in South America 200 years back, which was Spain. They squandered away the wealth, and they are one of the poorest countries today. Norway went on to legislate that this money will be used for posterity, for wealth transfer to future generations, and that's the genesis of this fund. And in the last 25 years, they have been a big force in the global equity market. But the point I wanted to highlight is the statement from the CEO of Norwegian Fund in 2021 December, that a 6% growth which they saw in the previous 2 decades may not repeat in the next several years. And in 2022, we saw minus 14% return for the fund. My last slide, you had 6.6% return for this fund from 1998 to 2021. And if you just take it to one more year, 1998 to 2022, it drops to 5.8%. This is the importance of capital preservation and risk management, which is of particular relevance to the audience here. With that, I'll stop. If there is time for questions, 1 or 2 questions, we can have that. Thank you.
Thank you so much, Mr. Krishnan. Maybe we can take 1 or 2 questions. Any questions? Okay. Thank you so much, Mr. Krishnan. We now move on to the next panel that's on the topic of emerging investment themes with family offices for long investing. Please join me in welcoming our moderator, Mr. Sanjay Patni, Associate Director, National Head, Institutional Sales from Mirai Asset Investment Managers. Members accompanying him is Ms. Benaifer, Chief Investment Officer, Ray Amit Patni, Family Office, Mr. Shekhar Jadhav, Director, Property Advisors Private Limited, Srinivas Shishadri, Head Investments, Mirabilis Investment Trust, Ms. Garima Bangar, Lead Private Investment at Chairman Family Office, Hero Motorcorp, and Mr. P. Krishnan, Managing Director, Chief Investment Officer, Spark Asia Impact Managers Private Limited. A very warm welcome to all of you. Please, a big round of applause for the panel.
All right. Good afternoon, everyone. I'm sure since morning we are seeing multiple sessions, and we started to hear why you are here. Okay, from those reasoning, till now we saw multiple things about markets, about sessions, about how equity markets are doing, and Swaroop did talk about on the part of risk and compliance and strategies. I think all of us believe that markets are here to stay, and that's where you make money about. Let me introduce myself. My name is Sanjay Patni. I head India for institutional business for Mirai Asset. Mirai is a South Korean asset manager and a pure asset manager managing close to $650 billion of assets worldwide and close to present in 55 countries now. One thing I can tell you, this is our 15th year running in India, and it's been a phenomenal journey for the organization in India. I think we are close to 1,20,000 crore of assets, and we're 10th largest AMC today, and continue to engage with investors like you and investors like you for sure for so long period of time. Let me go back, because when I read this panel session topic, let me go back a step back and say, I always like use analogies and to talk about it. Maybe that helps in understanding. I have only one point to say. I'm sure all of us follow cricket, right? All of us follow cricket for so long, being Indians, right? I'm sure all of us seen Sir Don Bradman. We always heard about him. He's been a great guy, fantastic cricketer, the best in the world for so long, true legend of the game. But why am I talking about him? What is more important is his career spanned in the cricket for almost more than 2 decades. 20 years, okay? We always compare, Tendulkar gets compared to him, and many others now, Kohli gets compared to him and all that. But let me tell you a more important thing, which is what the point which I'm trying to derive is his career of 20 years, with a strike rate of almost 99.5, plus scored almost 7,000 runs, 6,996 runs over 20 years. But let me ask you a question, all of you. Do you know how many sixes he has hit in 20 years career? Anybody can answer in the audience to me? I'll leave the question to panelists also. Anybody can answer that. Don't Google it. None. Okay, none. Less than 50. Anyone want to take a guess? Very few. Well, there you are. This is where the equity markets are. Now you know the answers. Okay.
He just one more question.
He just, huh?
Can I ask you one more question?
Please.
How many grounds did he play on?
22.
And
I'm a salesperson. No, I can answer.
His majority of matches he played on 5 grounds.
Yeah. Yeah, sure. So he was primarily against England most of the times, for sure. Let me tell you, in 20 years' time, he hit only 6 sixes. Only 6 sixes in 20 years, being the best batsman in the world ever in cricket, whatever you might say. So not 0 for sure. Okay. The point which I'm trying to derive, this topic tells me a very simple thing. He had the low risk, high breadth, strategic accumulation of run strategy with him. He was steady, he was sticking to his guns, took the stand, and continued to hit. The bowlers were scared of him. And he hit the runs when he didn't have safety guards also, if you recall. Those were the days. I'm sure you remember Gavaskar with the skull. I'm only trying to narrate here. All these gentlemen here and the panelists here are going to talk about next 30 minutes. I know I've taken 3 minutes of theirs, but also tell you that once you study, once you remain sticking to your guns, I think that's where long investing comes in. Irrespective what happens during that period of investments, you stick. You actually make money. On that note, let me introduce my panelist here. On my left, maybe Garima. Garima is from Hero Motocorp Family Office, Delhi. I have Banaifa with me from Amit Patni Group, Ray Global from Bombay. We have Srini from Bangalore, from Mirabilis K. Dinesh office. We have Shekhar from Pune, from Probity, and Mr. Krishnan from Chennai. So you can see all different cities in India, well diversified, and I'm sure they're going to accumulate various runs in this next 30-minute session. I can assure you that. On that note, let me come to you, because ultimately you guys are the stalwarts of making those and those. Let me jump to anyone. If you maybe let me jump to Srini. Srini, you have seen over a period of time the treasuries have evolved. You have seen over last many years now, maybe more than 10, 15 years now. What do you think is the next big thing treasuries have seen in this period?
Yeah, thanks, Sanjay, for the invitation here. Glad to be here among all of you. So I think 10 years is a long time. If we say the starting point is, say, somewhere after the taper tantrum, which was one of the bigger events from a financial market standpoint, things were quite glacial for at least 3-4 years after that. And we've seen, of course, a credit shock event back in starting the kind of tremor started in about 2016 and then finally hit in 2018. And then, of course, the large equity market drawdown during COVID and the subsequent recovery. I mean, 2-3 things to learn here. One is that equity investing or say asset class decisions cannot be very plain vanilla now. Yeah. We are living in a lot more volatile world. What we have to do is that we have to move away from a very simple asset allocation model framework to a risk pool framework, whereby you define as to what is the duration risk you want to take, what is the volatility or permanent loss risk that you want to take in the investments, and then carve out separate pools of allocation and start investing in those buckets. So that is point number one. The second development has been the heterogeneity of asset classes themselves, which have come up in the last 3-4 years. So I think when we started about 6-7 years, it was primarily a decision between public market and fixed income, a bit of VCP. Sure. Now I think a lot of alternative asset classes have emerged. We ourselves have moved to a multi-asset class investment model where we specifically identify pools of alternate asset classes, and within that also 3 or 4 different sub-pools of them, so that we do it. So I think these are the 2-3 things in which life has changed for us. The other final point is that I think risk management also needs to be more dynamic. So whether you are investing in an equity portfolio or a fixed income portfolio, it'd be sensible to understand what are the underlying constituents of investments which are there, and then what kind of risk reside in these. And it definitely helps anybody to evolve as an investor to spend some time doing that. So I think these are the 3-4 top of the mind things which come to me.
Sure. So continuing that, Shekhar, maybe I'm sure in a managing portfolio, especially long investing, there must be some metrics in your mind that these are parameters of profitability or a revenue or something what I look at. What are that in your mind?
At company level?
At company level, investment level, as a portfolio level, for example. Maybe selection of portfolio, I guess.
Yeah, so see, at portfolio level, most of the people don't, and I was chatting with Mr. Krishnan today morning, risk-adjusted return is something which, a lot of people don't understand and a lot of people don't pay attention to, unfortunately. Today, all of us know that GSEC 10-year is giving us anywhere between 740, 750. So that 1 unit of extra risk is giving you how much return, and is it worth taking that risk is something which many people don't pay attention to. So I think that is one specific thing, at a larger portfolio level. Sure. And of course, when you do allocations between debt, equity, of course you have to pay attention to how much alpha you intend to make on these respective allocations. Liquidity is one more aspect where you need to be careful, especially when you invest into PEVC kind of investments, or within public listed equities where the depth is not that great. You need to be very mindful of how much more capital you can put into that one specific stock or a specific sector. With respect to companies, of course, there are multiple parameters, but I feel capital efficiency is very critical to look at, and capital efficiency is very different at different stages of life cycle of the company. At very early stages, the capital efficiency is very critical for either building the product or acquiring the customers. And as the company grows, the capital efficiency needs to come into in terms of the ROE, ROC, and the reinvestment that you're looking at. So these are the broad, at different levels, what you would look for.
Sure. So Banaifer, if I were to move to you, I mean, what Shekhar also said, and the treasury side, Srini talked about, which sectors do you like the most? I mean, I'm sure the plethora, which I'm sure we are hearing since morning, but what is that you like and for family office to go along?
Thanks, Sanjay. So I'll just give you a little brief of what we've been doing. We've been at this for more than a decade now. I was just telling Sanjay in one of our chats. We started with the public markets naturally in varied sides, equity, public markets, and fixed income, etc. And slowly build on a private portfolio as well, which ranges from early stage company to mid-market companies, etc. And we have about 15 of them now. So we have a mixed range of what goes on in the public and private markets. And surprisingly, you will be shocked to know that there is a lot of correlation between all these put together, because the flows in the private markets are subject to what's happening at the macro level, to what's happening in the public markets, in debt and in equity. And I've been fortunate to see both sides of the world up close. Coming to what looks good, or in the public market side, I think today's market is very, very tricky to take a stand on, and we are waiting for the situation to evolve. But having said that, in the public markets, we are constructive on banks. We've had those positions for the last at least a year plus in some contexts. And on a little bit of the alternate side, we've been very constructive on silver. So these are two things that we've had. I mean, banks is very unanimous. I think most portfolios would have it. Historically, we had also played autos, which worked out well. So that's on the public market side. On the private side, it's very individualistic to which family is running what mandate and how it works. So for us, we did not want to build a very large team on the private market side. And we actually went about doing only 3 themes over these last 12 years. We started with consumer. We went on to take on fintech and financial services, because that's something that we understand very easily. And the last part we added was, which Sanjay told me, I did not know this word, how does it work, is content. Yeah. So basically when Mr. Ambani came on screen and said that I'm going to give 1,500 rupees may these mobile phones across to the next generation, we said it's content going forward. So that's what we've been doing, and hopefully we'll succeed at it.
I'm sure. There's no reason why not. I'm sure you're a breadman as well. Let me bring Garima in the conversation. Garima, you represent a house of vehicles, if I can use the word, maybe world's largest one, who are visionary. Where are you seeing electric mobility moving? Because that's a buzzword, and I'm sure 50% of the people must be aspiring to own, if not they own right now. What is your anything what audience should know about?
So very thoughtful of you to say that, calling us a house of vehicles. So as a family office, we keep a very close tab on the entire EV ecosystem, and we see that going forward in the next 3 to 5 years, the entire stock of the vehicles that we see on road is going to change, and it's definitely going to be EVs for sure. And it's because of the government push and the incentives that are there, the rising prices of the fuels, and of course, the awareness around the climate change. So we feel that, the entire stock is going to change, and, from the family office perspective, we keep a close tab on the entire EV ecosystem, be it, battery swapping, EVs, and the component manufacturers. So that is something that we really like to do. Another thing that is actually, playing out well in the recent is the D2C ventures that are coming up really well. That's because obviously the disposable income of the consumers have increased, plus the digitization has made it really possible for the upcoming companies to become brands, and the digital marketing has played a really good role in making the consumers aware about the brands. So I think these two themes we are currently playing on, and we believe that over the next 5 years this is going to be really good for the overall portfolio. So that's from my side.
Sure. I would say not 5, maybe more, I guess, a little longer to you for sure. Mr. Krishnan, if I were to move to you, I'm sure she talked about content, she talked about EV. Let me ask you a question. Economic uncertainty, I saw your presentation as well on the markets. Geopolitical uncertainty, even bigger. I'm sure I like the word called disruption. What do you see in the disruption today?
Yeah, so a lot of the global trends that I alluded to in the presentation are anti-themes rather than themes. They have a certain amount of negative connotation when it comes to the outlook for equity markets and equity investors. But like Sanjay mentioned, in anything that causes a lot of disruption, there may be opportunity. So obviously the previous speaker in the morning referred to China plus one. It's a much talked about theme, and it's playing out in some ways. I think the industrial companies who we've been speaking to increasingly mention that compared to the pre-COVID days, if they today increase prices, there is more acceptance from customers. In the pre-COVID days, maybe they just quietly went and bought from China. Now they are willing to accept a bit of price being passed on. Obviously, because of the geopolitical situation and supply chain related concerns. Now, this is clearly going to gather pace, and what is important for portfolio managers is to kind of, I think, look at this and see whether this can be played over a 2, 3, 4 year period. Usually in our process, we look at 2, 3, 4, 5 year trends, but I'm a very firm believer that 4 to 5 year financial forecasts don't make much of a sense in today's world. Has never made a lot of sense in the last many years. So you tend to then break it down to a 2-year financial forecast. Yeah. And then you have to be, I repeat, very careful about what you pay. And that is the biggest challenge in India. I must say that most of the things we look at just don't stack up. So, I really sort of, I think that the job of very big money managers is extremely complex today if they have to do justice to their job.
That too with the regulatory environment, I believe
Yeah.
so. Okay, sure. In the mid of 22, Srini, if I were to go back to you, I'm sure last year, mid of 22, we say storm. Okay, we made a lot of money before that. It was a value market. People made money. Now that storm is away, or are you still in the camp that no, storm is continuing?
I think there's no straightforward answer, but basically, the way I look at it is that asset prices or valuations and prospective returns are two sides of the same coin. So when say asset prices deflate like they did last year, it makes valuations more palatable and hence prospective returns improve. So for example, I think we've talked about fixed income earlier in the day as well in one of the sessions. So last couple of years when they gave fantastic returns just after COVID because everybody had a risk-off kind of approach to investing, that asset class delivered very well. Over the last year and a half, there's a very painful ratcheting of interest rates by central bankers globally. So this asset class has suffered for it. But now prospectively, it looks much better, right? Okay. So I believe a similar process is working through in the public markets, but not fully yet. I think we are halfway there probably when we started this year, and then now we also see last couple of months being a bit more painful. So I believe that will also work through this year, and then the asset class will again come back to the attractiveness. On the private side, I think new money is being raised at sensible valuations. But wherever valuations are very high for some of those growth stage companies, there is still holding back on whether to kind of come down on the valuation and start raising fresh capital. So I think that is still a bit, say, one step behind the public markets in terms of working it through. But this year, definitely from a starting point perspective, you have more options to invest and make returns against the risk-free part of the fixed income market. Looks great to start with, and that should be a starting point for you to evaluate prospective returns in every asset class and take decisions. That's how I look at it.
So you are saying risk-adjusted return like Shekhar talked about. Exactly. I'm sure you're in the same camp as well. Binaifar, if I were to move to you, I'm sure emerging opportunities beyond vanilla, I'm sure you talk about maybe basis to portfolio management, AIFs, anything which you like, which is something exceptional which you feel you've used and maybe you like the strategies.
So I was a part of a PMS team when the word PMS was not known.
Yeah.
Okay. And when I got a call for that interview, I still remember, I said, what is this word? The only one I know is related to women. So, coming back from there, that was about 2004 or so, 5. From there, this word has actually got its credibility in the last 3 years. And that's quite heartening because what we were trying to do back then is actually fructifying now.
Yeah.
This whole bit of AIF category 1, 2, 3 has opened up a whole new universe for us as investors. I'm sure all of people on the panelists feel the same. But it's also that much more tricky because there is no classification. Just like in mutual funds now, you have a very clear categorization. What is large cap? What is mid cap? What is multi cap? I think that categorization is completely missing in the AIF piece. So every fund has to be viewed in the light of dissected into the asset class, the risk return, the adjusted risk to be played on it, and then determined whether there is a suitability for it, right? So that's just the overarching piece of it. To answer what Sanjay asked, so there are credit opportunity funds which exist, there are venture debt funds which exist, there are infra yield funds which exist. So even road assets, etc., have started getting monetized. And as a ultra high net worth, my family office can use investments into this space. And these are more, and as we speak, it's evolving by the day. So every day I see a newer version of what can be done in the AIF side. But I think this space also is going through regulatory changes. There is a lot of streamlining happening. But it's encouraging because you see a lot of entrepreneurial spirit and fund managers taking up different genres, which is way back. I remember, again, to go back to that PMS time, we were trying to float a gold-linked debenture at that time. And you would not believe that all we managed to gather, and I used to be part of a very large house at that time, all we managed to gather at that time was a meager 20 crores, okay? And today, the whole, and this came only from about 3 sophisticated investors, because PMS used to have a 5 crore ticket, if you remember at that time. And that's how this world has evolved. And today, gold link, loans, etc., you see ads all the time of securitization happening. It's encouraging, but lots of things happening.
Sure, for sure. AIF's alternate markets have grown to almost 6.5, 7 lakh crores, so I'm not surprised at all. Shekhar, let me put you in a spot. Okay, let me ask you an odd question out. Which sector you are odd man out to not consider? Let 4 of them consider, but you'll say, no, I'll not consider it.
A specific sector.
Any sector.
So I feel, honestly, banks have already run up over last couple of years, and there will be credit growth for sure. And we also did participate in that segment, and of course made a lot of money. But I feel, again, going back to the risk-adjusted returns metrics, the amount of risk that you take and the valuations already peaking out in some of the banks, for sure. I think, that one segment I feel we should be very, very careful about.
Okay.
And select names, of course, will definitely perform well. But on a whole, I don't think, it will. It will pan out as, because it has become consensus now, and consensus most of the times don't work. So that's what I feel.
So you don't like 37% market, basically, of Nifty. Okay, sure. let me accept to that for sure. Garima, let me ask you a question. Any sectoral themes which you feel are maybe genuine from your family office perspective and maybe worth considering, looking at scale and maybe a sizable opportunity?
We have been looking at the offshore space for quite some time, and having watched the equity valuations where they are currently, we believe that the long only funds could really play out in the future, specifically in the autonomous vehicles and electric vehicles and associated technologies. So it could be like component manufacturing and also the technologies which are related to EVs. So that is something that we really look up to. Also, alternates is something that we want to look at, because obviously that provides risk-adjusted return, and the absolute return funds and long-short fund strategies, the strategies really play out well for us. So these are the themes that we want to look at for the offshore allocation. So obviously there are a lot of ETFs and funds which are doing this. So happy to look at all of those. So that's it.
Sure. Mr. Krishnan, I mean, just to continuing the conversation there, you have been managing funds for so long and you've been in the markets. How do you build that, portfolio, the life cycle of that portfolio? What are the characteristics you should look at it?
Yeah, thanks for that question, Sanjay. So let me start with this assertion that a good analyst may not be a good stock picker.
Sure.
A good stock picker may not end up being a good portfolio manager.
Sure.
So though these are, these can be, I think, taken as one continuum, doesn't work out that way. So to illustrate this a bit, the number of us and a lot of fund managers and laymen, they say, I bought HDFC Bank in 2001. And then 20 years, it's become whatever X.
Right.
But has your portfolio become that much X? We can ask a fund manager, individual investor, whoever.
Sure.
So, and one more distinction is that a professional fund manager has certain boundaries. So, when you operate on your own money, which family offices do in part, and then they engage professional fund managers, the boundaries tend to be different.
Yeah.
A professional fund manager, for instance, I'm usually amazed when fund managers say, over the next 10 years, I like this.
Sure.
Because over the next 10 years, they may not be in that job. Over the next 10 years, people are not entrusting money to them.
Sure.
So with these sort of constraints or considerations in mind,
Yeah.
when we construct portfolios, we have to look at the interplay of risks
Yeah.
that happen between stocks.
Sure.
And at the end of the portfolio construction exercise, do you have a good handle on whether there is consistency between what you thought you wanted to achieve and what is out there on day one? For instance, to illustrate this, if I say I'm very wary of global growth and end up having, let's say, a lot of IT services, right?
Yeah.
What am I trying to do versus what I thought or articulated? Now, it's a different matter that a lot of people in our industry articulate something and do something else.
Sure.
So that I'm not going there.
Sure.
But if you really have articulated something you believed in and you want to implement it, which is a fair thing to do,
Right.
then this construction should reflect that articulation, and you should have an understanding of the risks, therefore, you are taking in the portfolio, having constructed it in the first place. Then there is the issue of monitoring, because you mentioned the life cycle. So the biggest mistake that I think this, of course, I have learned it over many long years of making mistakes. The biggest mistake is to not recognize one. And people often ask, what is my stop loss? And, and usually stop loss is supposed to be a number, right? 10%, 5%.
Yeah.
For me, the stop loss may be a number. Of course, numbers are important. But a stop loss is also a significant deviation from what I assumed or what I thought would play out against what is playing out.
Sure.
And that's a very strict stop loss. One example I can give is that we had this exposure in one refining company, because we thought there was value and it made money for us in 2021-22.
Sure.
And then the Ukrainian war broke out. We exited that stock within probably days of the Ukrainian war breaking out, because it was clear to me that that was not in the picture.
Sure.
Nobody had that in the picture. So we can go on and on about it, but I hope I have just sort of encapsulated the thoughts on this.
Sure. No, completely agree with you. Srini, what are the real big opportunities do you think, and maybe sectors, anything specifically what you're looking at? What's interesting?
Yeah, maybe we've already had some discussion on the public market side, so I'll probably talk about something else here. So on the alternate side, there are two asset classes that we have been kind of allocating reasonably well. One is the question you asked about the real opportunities. So there are real assets, like for example, the infrastructure assets or say commercial buildings, etc. And then these get converted once they're completed, they turn into yielding assets.
Right.
So we believe this is a space where all investors should kind of, from an allocation perspective, spend enough time and understand how opportunities lie. Of course, you have to examine risks like the quality of the asset itself, who's the counterparty, who's paying you money, etc. But these could be offering you reasonably good risk-adjusted returns. That is one. The other part is that, again, venture capital and all we've already done, but the other piece which is opening up is the venture debt. So there we believe, again, you can look at investment managers who had at least 8 to 10 years kind of experience doing investments and look at their track records in terms of how their credit decisions and panned out. And then basis of that, you can take kind of some exposures if that seems to fit some part of your portfolios. I mean, these are the two things I would highlight. Yeah.
Oh, interesting to know, because that's one space which I've been talking to a lot of family offices and they have been really sticking to it. There is no doubt about it. Shekhar, let me ask you, I'm sure I had a long chats with you offline as well. Does fixed income at this level exciting for long investing, if I were to say?
So, yes, the short answer is yes. And so we've been allocating to fixed income, especially on the long duration, since last 6 odd months. And so, we kept our mod duration on the overall portfolio fairly low coming into, when the interest rates were going down to 2020-21. And so that really helped us because, the mod duration was very low. So, it did not impact too much on the yields overall. And as interest rates started going up, the mod duration was low. So, effectively we were, accruing a lot of income on that. But now I feel we are probably at the, fag end of the interest rate cycle. We probably one more hike or a couple of more hikes in India and the US. And, we've been laddering over last 6 months across multiple buckets, keeping in mind the liquidity requirements and the kind of carry that we are getting. So right now, yes, we keep adding into the 6-year, 5-year bucket and also the 10-year bucket. In the past, we've allocated to the 20-year bucket. So, it's, in my opinion, a great time to add to fixed income, especially long duration if you're, very low on the mod duration side.
Sure. Banaifer, I mean, this question I always ask, and many investors have always asking and understanding, liquidity management is important, whether short term, long term, what you're managing, etc. But there's always a challenge between balancing survival, growth we saw in last maybe 3 years, etc. Even before we getting into COVID, economies were in a bad state anyway. So where are you seeing and what kind of phenomena are you seeing and opportunities do you see there?
So on the liquidity management front, I think because our, our promoters have been encashed out of the business and we really don't have an operating business which requires continuous cash flow management. I think we are a bit lucky because we can have investment as a thesis and go across with that. The smaller requirements, or maybe if there is a major event in the family, etc., those are pre-known and that can be pre-planned. So there is nothing sporadic. So we actually don't do much of short-term or just 2-month, 3-month kind of things. We are not, I feel money lying outside in that bucket is really a waste for an investment return kind of perspective.
Understand, yeah.
So we are investors and we stay that way. In the context of what was looking good at COVID and post-COVID, see, COVID actually was a great time for shopping, to be honest. Yep. And, just leaving the health concerns aside, we were pretty agile to kind of see where we saw the opportunities. So, of course, the first part of it was that on the private side, we had kept reasonable amounts to bridge our companies because that was the first thing which was required. Most of them would not be able to anticipate the cash flows, and we didn't want them to run out. So that was first. The second thing was I still remember it was 2 months down the lockdown, and we started, heavily doing things on the equity side because we kind of felt that it was at great valuations at that time, and we topped up. At least the ones where we saw opportunity on the PMS side, we topped up there. So those were things that we did. We also saw a good amount of, like Srini mentioned, valuations became a little more reasonable, a little more, I mean, though I did meet some companies which were still gastronomically at 10x, and I said, okay, we'll see you in the next world. But, you know, we did get some companies who were more realistic, who understood what they wanted to raise, and their sustenance was more important than things. And we did deploy some monies into those fields as well.
Sure. So Garima, I mean, to ask you the question, because this is something which I have not asked till now, maybe overseas investment opportunity, does that chord strike your family office? Anything, any sector worldwide which you feel, other than EV, if I were to ask you that? So that's, I'm sure, your favorite
that's
one.
Obviously quite important to us.
Yeah.
But you know, the other themes that we want to look at is definitely you know, sustainability, climate tech, and obviously the green energy, so to say. These are going to be the upcoming sectors for sure. Also, in terms of the kind of asset classes that we want to allocate, is basically the fixed income, you know, I would say bonds or other opportunities, fixed income funds that other panelists have also talked about. So, you know, we are looking at the longer tenure or longer duration funds. And because, you know, there are two sides to it. Either you hold them till the end and obviously you know, and cash the YTMs and, you know, just realize the YTMs. Or maybe, you know, just, you know, if you want to, you know, realize them in between. So you, once there is a interest rate reversal happening, so you are bound to gain from the MTM gains. So that is something that we want to look at. And fixed income opportunities, as well as the other themes that we want to play out is climate tech, digital greens, and things like those. So digital economy, so to say, digital economy and digitization. Although India is ahead of the curve, but for the other countries, I think it's still to happen, and it is bound to happen for sure.
Ahead of the curve without listed companies in space. Fair point. So that we agree with you for sure. Mr. Krishnan, you have seen a long journey in equity markets. This is one thing which I'm sure will excite everyone to understand. And I see some of the partners here, data, technology, the speed of data, if I were to say. How is that changed in helping you in taking decisions now? Because portfolio management with equity T+1 now, I'm sure it is even further challenged.
I'm not sure whether it's helping us because it's causing a lot of issues. There is a surfeit of information, and handling emails, even for somebody of our size, is a challenge. So when it comes to technology, the first point that should be noted is technology is a tool and not a solution. So in the pre-technology days, as it were, we had tools which still managed to keep track of data. You know, I remember we had a database of 600 or 700 files. Somebody used to cut newspaper clippings, paste it. I've known investors in those days who bought one share of each company so that they can get an annual report and put it in the file. So this became, that was the technology of those days.
Correct.
And it sounds very primitive, which it was. That was what was available, and we moved on. And now you can't obviously operate on that model, and you need not. So to put it in plain speak, I think Excel was the biggest technology tool that happened to this industry, and nothing much has happened after that so far. Now, Excel was a big leap. And I think, you know, post that, I don't know whether it has been, you know, technology has not given us sort of, I think, such huge productivity improvement. Of course, I think tools that are coming in. On the topic which I see being talked about, whether technology can sort of take over the fund management role and, you know, ChatGPT and whatnot, I think, at least in the Indian market, we are very far away. This is, if this were not mispriced, then we'll be out of a job. Most of the time, this is mispriced.
Correct.
And such mispricing is due to not just fundamentals or information availability, which today is more or less democratic, but because of the huge sentiment swing in the marketplace. And I don't know whether technology can map that in a big way. So to answer your question directly, I think since Excel, I haven't seen massive improvements in technology, sort of, I think, helping investments. I'm sure people are using. I remember we used a tool which helped us, for instance, if you give a keyword which will kind of ferret out all kinds of data. But that particular venture somehow, I think, didn't do all that well. So people are still figuring out various ways to cut through the huge overload of information we are faced with. I'm sure there will be a breakthrough in the coming years.
I remember Harmanpreet Kaur getting out like that, the last second. Okay, when the bat got stuck at the last minute, I agree to that for sure. So let me ask you one word answer, okay? Let me put you in a spot and asking you, Garima, one word answer. Which one sector you are averse to? Quick one word answer.
Real estate.
Okay, Banaifer.
I think real estate.
Real estate. Commercial, residential. Wholesome. Okay. Yeah, Srini.
Cyclicals.
Cyclicals. Okay. You remain stickier to BFSI? Infra. Okay. Okay.
Yeah, at this point, IT services.
Services.
Yeah, IT services at this point. But this, let me qualify it, this can change any time.
So which one sector which you are 500% confident about? Now you are going diplomatic as a fund manager.
It's not diplomatic at all. I'm saying that I don't believe that we need to have a permanent view on these things.
Sure.
If you ask me a topic.
Prevailing, current conditions, yeah.
Current question was
which one sector which you are averse to completely?
IT services.
IT, fair. Which one sector you are 500% confident about?
Banking.
Banking, okay. Shekhar, now you answer this question. Which one sector you are 500% confident about? And
Fixed income.
Fixed income, 500% confident. Srini?
And the equity, I think, relative preferences for consumer sectors now.
Consumers, okay. Benaifer?
I think fintech in India.
Okay. Don't tell EV, tell anything else.
Yeah, sure. It would be consumer discretionary and I would say machining, automation and machining, manufacturing.
Sure. I can only tell you one thing for sure, okay? I'm sure all, sorry, tell me, please.
So the answer was with reference to the stock market,
Yeah.
where it is, and not on the outlook for the sector.
Fair point. That's fair point. The disclaimer always part of BFSI sector. Okay, ask me. Okay, so my only question is, I'm sure all of us are habitual of watching 2020. All of us are habitual of, we can watch WPL, Women Premier League also now, but I can also tell you I have some test players here sitting. Okay, end of the day, stalwarts of cricket always came from test cricket, who had the ability to duck the bad ball, to leave the bad deliveries, and to wait for the good bad deliveries to hit, and you wait for opportunities to get kicked about. So that's important. You have to be patient and perseverant to have long investing. So let me allow and ask you to have a round of applause for the panelists for being the test players of long investing. Thank you so much, all of you panelists, for sharing your views with the audience. Thank you so much, everyone, for listening patiently. Thank you so much.
Thank you so much, Sanjay, and the panelists for that fantastic insights. Sanjay, if I could request you to felicitate our panelists. Ms. Benaifer. Mr. Shekhar Yadav. Mr. Srinivas. Ms. Garima. And Mr. Krishnan. Great. Thank you, all the panelists once again. Big round of applause for the panel, please. So great, it's been a fantastic and a very insightful first half. So we now break for lunch.